secular approach who have also been very successful. Let's take Warren Buffett of Omaha, Nebraska. If you had put $10,000 in 1965 into his company, Berkshire Hathaway, you would have $1 million today.
How to retire at 35. Have you ever wondered what it would take to retire at 35? To wake up every morning knowing you don't have to work. You choose to. That's not a fantasy. It's called financial freedom, and it's something anyone can build with the right mindset, habits, and strategy. Today we'll break down how to achieve early retirement, what it really means, how to reach it step by step, and why chasing risky get-rich schemes is the fastest way to lose it all. What does retirement at 35 really mean?
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
When people hear retirement at 35, they imagine yachts and beaches. But real early retirement isn't about quitting life. It's about owning your time. It means your money works harder than you do. It's when your passive income from investments, businesses, or assets covers your expenses, freeing you from the need to trade time for money. This is what Warren Buffett calls making money while you sleep. Financial freedom isn't about luck or high salary. It's about understanding how money flows and directing it wisely.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Step 1. Know your numbers. The foundation of freedom. You can't build wealth if you don't know where your money goes. Track your income, expenses, and savings. If you earn $2,000 a month and spend $1,900, that's not freedom, that's survival. The goal is to live below your means, not because you're cheap, but because you value future freedom more than short-term pleasure. Start by building your financial safety net, an emergency fund of 6 to 12 months' expenses. This is your protection against life's surprises. As billionaire investor Ray Dalio says, those who live without a safety margin eventually find themselves without freedom. Step 2. Build assets, not liabilities. Most people spend their lives buying liabilities. Cars, gadgets, expensive lifestyles. The rich buy assets, things that generate income.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. Yeah. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
Robert Kiyosaki, author of Rich Dad, Poor Dad, built his philosophy on this. The poor work for money, the rich make money work for them. Invest in things that grow, dividend-paying stocks, real estate that cash flows, index funds, businesses, your own skills and education. Every dollar you invest wisely brings you closer to freedom. Every dollar you waste pushes it further away. Step 3. The myth of high risk. Why fast money fails. Many people lose years of progress chasing fast profits. Crypto, meme stocks, risky trading. Yes, a few get rich quickly, but for 95% of people, it ends in loss. Even Warren Buffett, the world's greatest investor, says if you don't understand it, don't invest in it. Instead of gambling on trends, focus on consistent growth. Small, steady returns compounded over time beat big risks that crash overnight. Financial freedom isn't built on excitement. It's built on patience, knowledge, and discipline.
How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's an intellectual process.
Step 4. Optimize and multiply. The path to wealth. Once you've mastered saving and investing, the next step is optimization. Automate your finances. Make saving and investing effortless. Cut waste. Subscriptions you don't use. Unnecessary spending. Lifestyle inflation. Then look for ways to multiply your income. Start a side business. Learn new skills, or create digital products. The goal is to increase your income and your savings rate. If you can save 50% of your income, you could reach financial independence in about 15 years, even with average returns. Real stories of early retirement. Take the example of Grant Sabatier. He went from broke to millionaire and retired at 30 by saving aggressively and investing smartly. Or Christy Shen, who left her job at 31 after building a portfolio that generates enough to live anywhere in the world. They didn't win lotteries or take huge risks. They simply understood one truth. Freedom is earned through consistency, not luck. Retiring at 35 isn't about never working again. It's about having the freedom to choose what you work on, when, and with whom. Financial freedom isn't the finish line. It's the foundation for a life on your terms.
And the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your level, defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM?
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
Your freedom starts today. Subscribe to Titanium, where we turn financial literacy into real-world freedom. Because the best time to start was yesterday, the second best time is now.